Welcome to the research desk. Imagine building a machine in a pristine, climate-controlled laboratory.
Right, a totally frictionless environment.
Exactly. In that environment, the machine operates flawlessly. It runs complex mathematics, it perfectly anticipates market movements, and honestly, it prints money with absolute precision.
But, and there's always a but, the second you take it out of the lab,
Yeah, the exact second you place it into the real world, the friction of the air causes the gears to grind, the engine overheats, and, well, the entire apparatus catches fire.
that is a very dramatic but frankly accurate analogy.
Today, we are examining the financial equivalent of that machine. We're confronting a phenomenon that operates almost entirely in the shadows of institutional finance, yet it dictates the survival or failure of virtually every systematic trading model ever conceived.
We are talking about transaction costs.
Transaction costs, the silent killer of alpha. We are exploring the big question here. What if the most impressive, visually stunning strategy in a historical backtest is actually the exact strategy that investors should fear the most?
The stakes of this discussion really cannot be overstated. We aren't talking about marginal adjustments to a quarterly return profile, or some slight drag on performance that an allocator can just casually ignore.
No, we're discussing the total destruction of strategy economics.
Exactly. The empirical data across our industry indicates that between 30% and 70% of apparent outperformance
Sure.
is routinely lost. Lost to costs, frictions, and implementation shortfall.
30 to 70%. That's massive.
It is. If an allocator looks at a quantitative strategy that earns 12% in a frictionless simulation, they must deeply internalize that it may deliver only, 6% in actual practice.
Yeah.
That gap is not a rounding error. It is the difference between a top decile mandate that secures a pension fund's liabilities and a profound fiduciary failure.
I will argue that implementation is everything. It is the ultimate determinant of whether a strategy has any economic value in the real world.
And I will defend the position that signal quality still matters most. Execution is critical, but it cannot manufacture returns out of a fundamentally flawed premise.
Well, we're going to trace this widening gap between paper alpha and realized returns today. We'll go through historical precedents, the micromechanics of institutional cost structures, and capacity governance.
Sounds like a full agenda?
Let's establish the foundation here. My core premise is that paper alpha, the return generated in a backtest, is nothing more than a research statistic.
A hypothesis, basically.
Exactly, a hypothesis. Net alpha, the capital actually deposited into a prime brokerage account after all trading is complete, is the only reality. The ultimate metric we must focus on is implementation shortfall.
Right, drawing on the work of Arnott and Wagner there.
Yes, and later expanded by Collins and Fabazi. For the listener, implementation shortfall is not some abstract theory. It is the exact, measurable mathematical difference between the decision price and the final execution price.
The decision price being the literal millisecond your model says buy at $100.
Right. Versus when that asset actually settles in your portfolio, perhaps at $100.10. That 10-cent delta contains a multitude of sins.
Spread, impact, delay.
All of it. It captures the bid-ask spread you must cross, the market impact you cause by demanding liquidity, the opportunity cost if you delay, and the penalty of trading alongside crowded peers. A pure signal without flawless execution is a phantom. It is the implementation apparatus that acts as the ultimate filter of economic value.
I come at it from a different way. I fully acknowledge that implementation shortfall ruthlessly destroys weak strategies. But execution skill cannot repeal market impact.
It can mitigate it, though.
Mitigate, sure, but it cannot save an overcrowded, fundamentally saturated signal. Without a pure, proprietary, and highly robust underlying signal, there is absolutely nothing for the execution desk to preserve.
So you're saying a bad signal is just a bad signal, no matter how well you trade it?
Exactly.
Consider the baseline logic here. A perfectly implemented zero alpha signal still yields exactly zero. If the underlying research edge is commoditized, or if the factor exposure is known to thousands of other participants, your execution doesn't save you.
Even with top-tier routing.
Even then, if the predictive power of your statistical model is simply illusory, The most sophisticated algorithmic routing in the world will merely ensure that you execute a losing trade with maximum efficiency.
Okay, that's a fair point. Maximum efficiency on a losing trade is still a loss.
Execution is inherently a defensive mechanism. It prevents the spillage of alpha. But the signal is the engine. It is the sole source of positive expectancy in the market.
I see where you're going, but let's look closely at how that spillage actually occurs mechanically. We both accept the common ground that 30 to 70% of gross outperformance vanishes.
We do.
To understand exactly how that happens, I view a systematic trading strategy as being exactly like a global supply chain. Think of a physical supply chain for highly perishable fruit.
Perishable fruit. Okay, I like this.
You have multiple, tightly sequential failure points. You have the raw material extraction at the farm, the packaging, the logistics of transport, the temperature-controlled warehousing, and final delivery.
Right, and if the refrigeration fails,
the entire product rots. If a shipping channel is blocked for a single day, or a warehouse loses power for 2 hours, the profitability goes to zero. A systematic trading operation faces the exact same sequential fragility.
So the signal generation is just the farm in this analogy?
Yes. The mathematical model saying buy is merely the raw material. The routing algorithms, the order sizing logic, the latency of the physical infrastructure, those are the critical logistics links in the chain.
I accept your supply chain analogy, but we really must follow it to its logical conclusion. A flawless supply chain that perfectly, efficiently, and rapidly delivers a completely worthless product still results in corporate bankruptcy.
Well, obviously.
The product, the signal itself, must have intrinsic, undeniable economic value. That value is what justifies the immense cost of building that supply chain in the first place. We see quantitative firms spend tens of millions of dollars optimizing their infrastructure.
Laying specialized fiber optic cables?
Exactly. They use microwave towers between Chicago and New Jersey to shave literal microseconds off their latency. They are essentially building the world's most pristine logistics network.
Which proves my point about how important it is.
But wait. If the alpha model is trading a well-known statistical arbitrage mean reversion that 50 other funds are also running simultaneously, that pristine supply chain is delivering a highly commoditized product. The intrinsic value of the signal is what creates the margin.
A uniquely uncorrelated signal provides a margin of safety, you mean?
Yes. A highly predictive signal provides the absolute margin of safety that allows for minor inefficiencies in the supply chain. If your signal's powerful enough, it can withstand a suboptimal fill rate.
I have to pause you right there. You mentioned shaving microseconds and having a margin of safety. I want to make sure we make this perfectly tangible for the listener.
Sure, go ahead.
When we talk about latency and a suboptimal fill rate, we are not talking about a trader being slow to click a mouse. We are talking about the physical reality of modern electronic markets.
Right, the machine-to-machine combat.
Exactly. If your logistics, your execution infrastructure, is delayed by 5 milliseconds, high-frequency participants observe your intent. They see a fragment of your order hit one exchange, calculate that you need to buy the rest on another exchange, and they race you there.
The classic latency arbitrage setup.
They buy the liquidity and sell it back to you at a higher price. If your supply chain fails at this micro level, your signal does not matter at all. The market marker structure will devour your alpha before your pristine signal is even fully expressed in the portfolio.
I don't disagree with the mechanics of latency arbitrage, but that transitions directly to the concept of scale, the assets under management, and the physics of alpha decay.
The pressure of volume passing through the infrastructure.
Exactly. The foundational research of Perold and Salomon established a critical thesis. The exact amount of assets managed matters intensely because alpha shrinks exponentially as assets grow.
Because the orders get larger.
Right. When an institution allocates more capital to a strategy, the underlying orders inherently get larger. As those orders grow, information leakage into the broader market increases, and market impact rises in a nonlinear fashion.
Yes, and I apply a physics analogy here. Alpha decay begins the exact moment the strategy touches the market.
The observer effect.
Precisely. It is highly analogous to quantum physics, specifically the observer effect.
In quantum mechanics, the mere act of observing a particle changes its state.
And in quant finance, extracting alpha degrades the alpha.
It physically alters the market environment, immediately degrading the alpha itself. It is a physical law of market microstructure. You simply cannot push $1 billion through a narrow liquidity window without moving the price against yourself.
You're constrained by the order book depth.
Right. If you are trying to buy 1 million shares of a mid-cap stock, there might only be 10,000 shares available at the current bid-ask spread. To get the rest, your algorithm has to reach deeper into the order book,
Paying higher and higher prices for every subsequent block.
Exactly. The larger the execution, the more you displace the market, and the faster the theoretical decay accelerates. Therefore, the implementation constraints are what define the physical boundaries of the strategy's universe, not the theoretical capacity of the mathematical model.
The physics of market impact and the reality of the order book are undeniable, but you are missing the crucial variable here.
Which is?
It is the signal quality that dictates exactly how much capacity a strategy possesses before the physics of decay overwhelm it. The signal determines the timeline. Let me contrast two different signals to illustrate this.
Okay, let's hear it.
Signal A is a fast-reverting, highly crowded mean reversion strategy. It identifies short-term mispricings that correct within minutes or hours. The moment signal A touches the market, the decay is immediate and violent.
Limiting its total capacity to, maybe $50 million?
Exactly. Now, signal B is a unique, deeply researched alternative data signal capturing a structural mispricing over a multi-week horizon. Because the signal duration is longer and the insight is highly proprietary, the physics of decay are delayed.
So you're arguing signal B can handle more volume without hitting that nonlinear impact wall?
Yes. Signal B might comfortably scale to $5 billion before Perold and Salomon's nonlinear impact curve steepens enough to erode the gross return. The execution desk does not magically create that $5 billion of capacity.
No, but they have to navigate it.
But the intrinsic nature of the signal, its duration, its uniqueness, and its predictive strength determines the exact shape of the decay curve. The signal quality sets the structural ceiling for the assets under management.
To test those structural ceilings, we must move from the theoretical physics of alpha decay to a historical stress test. When we look at extreme market events, we see exactly what breaks first.
You're going to bring up 2009.
The momentum crash of 2009 provides the ultimate proof that implementation dictates survival. Let us look closely at the exact events of that period. In early 2009, standard momentum strategies were aggressively positioned based on the trend of the previous 12 months.
Which was a massive bear market for financials.
Exactly. To be specific, they were heavily short, high-beta financial stocks, the banks and institutions that had been entirely decimated during the 2008 global financial crisis. Conversely, they were aggressively long, defensive, safe haven equities.
It was perfectly aligned with the prevailing macroeconomic reality of the time.
Until it wasn't. In March 2009, the market experienced a violent, unprecedented inflection point. Financials rallied exponentially off their absolute bottoms, and the safe havens lagged significantly.
The reversal was brutal.
Now, technically, the purely theoretical momentum signal survived the initial volatility. The mathematical logic of the trend model remained intact on paper. The algorithms correctly identified that a reversal was happening.
Right, the model saw the trend breaking.
But the implementation spectacularly failed when real money hit real markets. As the short positions in those financial stocks began to squeeze rapidly higher, momentum funds were forced to deleverage. They had to buy back their shorts to avoid margin calls.
And everyone was trying to exit the exact same door at the exact same time.
At that exact moment, implementation shortfalls skyrocketed because liquidity evaporated entirely from the order books, precisely when they needed to cover.
The execution mechanisms broke down under the stress of forced, synchronized trading.
The liquidity void.
The models were fundamentally sound based on historical data, but the total inability to execute the necessary portfolio turnover without causing catastrophic market impact is what destroyed the capital. Implementation, the physical act of getting out of the trades, was the single point of failure. That is a highly detailed historical account, but it misidentifies the fundamental root cause of the destruction. The momentum crash of 2009 was a unique systemic regime shift. The failure was fundamentally a failure of signal design, not simply an execution breakdown.
How can you say that when the order book literally couldn't handle the trades?
Because the standard momentum signal of that era was too naive. It failed to adapt quickly enough to a sudden, violent shift in market microstructure and cross-asset correlation. You are blaming the execution desk for failing to cleanly liquidate massive short positions during a historic short squeeze.
Because they couldn't.
But the underlying flaw, the fatal error, was that the signal drove the portfolio into an unhedged, hyper-concentrated factor exposure, right at the turning point of a generational bear market.
Wait, let me challenge that specific premise. Are you suggesting that a better signal could have accurately predicted the exact week the Federal Reserve and Treasury interventions would cause the banking sector to rally?
No, I am suggesting that a robust signal framework does not rely on predicting the exact week of a central bank intervention. A more sophisticated signal, perhaps one that incorporated dynamic volatility scaling, would have behaved differently.
By reducing exposure preemptively?
Yes. Or one that utilized regime switching parameters to detect extreme correlation spikes across sectors. That kind of signal would have systematically reduced the gross exposure before the short squeeze became fatal.
But the momentum signal was purely trend following. Exactly. The signal would have recognized the fragility of the macro environment and sized down. Instead, the naive momentum signal kept the pedal to the floor. It is a blended failure, certainly, but you cannot separate the execution disaster from the signal failure.
So the signal marched them into a trap.
The execution failed so spectacularly because the signal placed the portfolio in an untenable, deeply illiquid corner of the market, entirely on the wrong side of a systemic reversal. The signal marched the army into a swamp, and you are blaming the logistics officers for not being able to maneuver.
That's a fair analogy, but we can debate the black swan events and the swamps all day. Surviving a once-in-a-decade crash is really only half the battle.
The day-to-day survival is just as hard. The real, persistent killer isn't the sudden crash. It is the invisible, daily bleed of institutional costs. We must address the daily, grinding tax of institutional trading.
Keim and Madhavan's work comes to mind here.
Yes, Keim and Madhavan published definitive research illustrating exactly how equity trading costs systematically devour alpha. They did not just look at broad performance drag, they itemized the exact mechanisms.
Which is crucial for allocators to understand.
For the listener, we need to break these down. First, you have visible commissions and broker fees. Second, you have regulatory taxes and exchange fees.
Those are the explicit costs.
Right. Third, you have the crossing of the bid-ask spread. If the market is bidding $10 and asking $10.05, you immediately lose 5 cents the moment you demand liquidity.
That spread crossing adds up incredibly fast.
Fourth, the market impact of moving the order book, which we discussed with the physics analogy. Fifth, the timing delays while waiting for liquidity to replenish on the exchange.
And the opportunity costs.
Exactly, the final one. The opportunity costs of partial fills, where your model wants to buy 10,000 shares but can only acquire 3,000 before the price moves away.
Their empirical conclusion on this was stark.
In high turnover strategies, these costs reliably consume 30 to 50% of gross returns. This is not an occasional penalty during a crisis. It is a permanent daily tax on your capital.
And the academic models usually ignore it.
Yes. Furthermore, the extensive work of Lee, Chow, Picard, and Garg demonstrated that factor investing transaction costs are systematically higher than academic models assume. The academic models assume continuous, infinite liquidity and flat implementation curves.
Which is a fantasy.
The reality of the market is discrete, fragmented, and punishingly expensive.
I completely agree with the empirical evidence of that daily tax. It is an immutable law of the market. To illustrate the profound tragedy of ignoring it, I will share the story of a specific momentum fund launch.
This is a permanent cautionary tale for our industry.
It really is. A highly pedigreed quantitative team comprised of brilliant researchers developed a short-term momentum fund. They ran exhaustive, computationally heavy backtests spanning 2 decades of market data.
The backtests always look beautiful.
Oh, the strategy produced a massive, highly consistent 15% gross alpha. The models were mathematically beautiful. Based on that 15% projection, they raised significant institutional capital.
But they didn't respect the spread.
No, the researchers treated slippage and transaction costs as a mere nuisance. They applied a static assumption of a few basis points per trade baked into the end of their simulation. They assumed the market would simply absorb their orders effortlessly.
Which never happens.
When the fund went live, the reality of Keim and Madhavan's research crushed them. The strategy inherently required high turnover to capture the short-term trends it identified.
So they were paying that tax constantly.
Daily, by crossing wide bid-ask spreads daily and suffering severe market impact on their larger institutional order sizes, that beautiful 15% gross alpha rapidly evaporated. They delivered a mere 6% net live return to their investors.
Let me stop you there. This is the exact crux of the issue. You were describing a scenario where a 15% theoretical return dropped to 6% simply because of spreads and execution realities.
900 basis points, just gone.
I want to walk through exactly how 900 basis points vanish. To a layman, it sounds almost impossible to lose 9% of your return just by executing trades.
It is incredibly easy if your turnover is high enough. Let us do the math.
Let's do it.
If your strategy turns over its entire portfolio twice a month, that is 2,400% turnover annually. Now, if your average cost to execute a trade, combining the bid-ask spread and the market impact of your order size, is just 20 basis points.
Or 0.2%.
Right. You multiply that tiny 20 basis points by the massive turnover, that immediately equates to nearly 5% in pure execution drag.
And that's before all the other fees.
Add in exchange fees, short borrowing costs, and the opportunity costs of trades that were signaled but never filled because the price ran away. That is how you lose 900 basis points.
The math is terrifying.
They fundamentally misunderstood that slippage is not a nuisance variable to be added at the end of a backtest. It is the central economic variable in high turnover trading.
That story perfectly illustrates how this institutional tax applies to modern, highly complex quantitative methods. When we look at the current landscape of machine learning strategies, we see this alpha shrinkage occurring at an industrial scale.
Machine learning is particularly vulnerable to this.
Extremely. I have analyzed numerous quantitative programs utilizing advanced, nonlinear machine learning techniques. We're talking neural networks, random forests, deep learning models applied to limit order book data.
And they find incredible micro-inefficiencies in simulation.
In simulation, these models are exceptionally good. They print exceptional gross alpha, often in the range of 8 to 12%. But here is the structural problem. Machine learning models tend to identify highly transient short-horizon signals.
The edge disappears quickly.
The mispricing they find might only exist for a few minutes or hours. Therefore, they mandate extremely high turnover to capture the edge before it vanishes.
Which triggers the exact math we just walked through.
Precisely. Once the institutional cost tax is applied, the spread, the impact, the latency, that 8 to 12% gross alpha routinely shrinks to a mere 3 to 5% net return.
It's a massive haircut.
I view this through the analogy of moat economics. In traditional corporate business strategy, an economic moat protects a company's profitability from competitors. A wide moat means you have pricing power and durable margins.
So how does that apply to ML models?
In quantitative finance, if a strategy loses more than half of its alpha to execution costs, losing 7% to capture 5%, it possesses a fundamentally weak economic moat. The margin for error is razor thin.
One small change in market structure and you're negative.
Exactly. If exchange fees increase slightly, or if a single new high-frequency competitor enters the same routing venue and starts competing for the same liquidity, that remaining 3% net return vanishes overnight.
It's a precarious position.
A business model that sacrifices 70% of its gross revenue merely to operate its logistics and supply chain is structurally precarious. It is not an investment, it is a highly leveraged bet on execution perfection.
You define the moat based on cost retention, but I look at the absolute difficulty of generating the positive return in the first place. I argue that delivering a 3 to 5% net return in the hyper-competitive, fiercely adversarial machine learning space actually proves that the signal is doing the heavy lifting.
How so? 3% is a tiny margin.
Think about the supreme efficiency of modern electronic markets. Generating even 1% of true uncorrelated positive expectancy after costs is extraordinarily difficult. It requires finding a genuine inefficiency that thousands of other brilliant minds and supercomputers have missed.
True. It's a hard game to play.
No amount of implementation trickery, no sophisticated routing algorithm, and no latency reduction can generate a 3 to 5% net return from pure noise.
I'll grant you that you can't manufacture alpha from noise.
The execution infrastructure is merely allowing the underlying statistical truth of the machine learning model to shine through. The fact that the strategy survives the punishing institutional text you just described and still delivers a robust net return is a testament to the absolute power of the proprietary signal.
So you think the signal is the real moat?
Absolutely. The moat is the intellectual property of the machine learning architecture. It is the feature engineering, the model training, the unique data ingestion. It is not the routing algorithms. The routing algorithms are a commodity you can buy. The signal is the rare asset.
Yet we have concrete historical evidence where the execution is the primary driver of alpha preservation, effectively becoming the moat itself. Let us shift our focus from how alpha is lost to how it is actively preserved through elite execution.
The defense against alpha decay.
Right. The defense against alpha decay is not just having a better, more complex signal. It is deploying highly intelligent execution frameworks that actively manage the market microstructure.
Indeed, and the academic literature heavily supports this defense. Novy-Marx and Velikov produced brilliant research demonstrating how smart rebalancing can mathematically salvage a strategy that would otherwise be destroyed by costs.
They looked at anomaly strategies, right?
Yes, they studied high turnover anomaly strategies. These are strategies that identify mispriced stocks but require constant trading to maintain the exposure. They introduced sophisticated trading rules specifically utilizing banding techniques.
So instead of rigid rebalancing.
Exactly. Instead of blindly rebalancing a portfolio to exact target weights on a rigid schedule, say every Friday at the close, which is highly predictable and easily front-run by other market participants, you only trade when an asset's weight drifts outside a predefined tolerance band.
Letting it drift saves turnover.
If your target weight is 2%, you might do nothing until it drifts to 2.5% or 1.5%. By implementing this intelligent delay and by utilizing liquidity-aware sizing, they showed something remarkable.
Which is?
Smart rebalancing can save 40% or more of the transaction costs that would otherwise be lost to the market. This is a profound retention of capital. It proves that how you trade is just as vital as what you trade.
It definitely emphasizes the importance of the execution layer.
But to truly understand elite execution and its relationship to the signal, I must share the story of Renaissance Technologies and their legendary Medallion Fund. Medallion is widely considered the most successful quantitative fund in the history of finance.
Their track record is unprecedented.
What made Medallion unique was not just that they found hidden esoteric signals. It was how they perfectly integrated those signals with their execution infrastructure. They built entirely bespoke order routing systems.
Internal crossing networks, too.
Yes, they internalized crossing networks to match trades internally without paying exchange spreads. And they developed an unprecedented understanding of market microstructure. They knew exactly when to aggressively demand liquidity to capture a fleeting opportunity.
And when to be passive.
Crucially, when to passively provide liquidity to the market to earn the spread rather than pay it. By executing with such microscopic precision, Medallion turned implementation from a defensive, necessary tax into an offensive competitive advantage.
Which completely shifts the economics.
They could successfully trade weak, marginal signals that other quantitative funds found utterly unprofitable, simply because Medallion's execution costs were fractionally lower. They proved that when immense signal quality is paired with bespoke elite execution, you achieve the holy grail of systematic trading.
I find it fascinating that you invoke the Medallion Fund, because I believe the Medallion story definitively proves my point, not yours.
How so? They had the best researchers in the world.
Yes, but the fact that they could trade signals that were unprofitable for everyone else means the signal itself was not the unique differentiator. The implementation was the competitive advantage.
But the signals had to exist.
Sure, but if another fund had acquired the exact same signal but utilized standard off-the-shelf prime broker execution, their return would be zero or negative. Without Renaissance's unparalleled, deeply customized execution infrastructure, their underlying high turnover signals would have been entirely arbitraged away by the broader market.
You're saying the infrastructure manufactured the alpha.
Medallion did not just preserve alpha. Their execution apparatus effectively manufactured the net alpha by reducing frictions to near zero, and in some cases, earning rebates by providing liquidity.
That is a very specific interpretation of their success.
It demonstrates that when signals inevitably degrade over time and become commoditized across the industry, the entity with the superior implementation framework continues to extract massive value while everyone else fails. The signal is transient. The execution infrastructure is the permanent moat.
They extracted value because they integrated the two flawlessly. You cannot build Medallion's execution infrastructure without the predictive models informing exactly where and when to deploy that infrastructure.
But let us move from the theoretical and the historical to the practical application of these lessons. This brings us to the wildcard of our entire analysis: capacity governance.
The most critical control variable.
All of the physics of alpha decay, the crushing reality of institutional costs, and the complexities of execution ultimately culminate in how an asset allocator governs the strategy. Capacity governance is the central control variable.
Because strategies rarely die a peaceful death.
Strategies do not naturally die a peaceful death in the market. They are often actively killed by their own management firms. The fundamental conflict of interest in quantitative finance is this: management fees are driven by increasing assets under management, while net alpha is driven by strictly restricting those assets.
Firms get greedy.
Firms continually sell their strategies well after the research edge is saturated. They push the strategy beyond its optimal capacity, ignoring the physics of market impact, and drive the fund right into the steep end of the decay curve.
It happens every cycle.
Exactly. This dynamic requires a strict, uncompromising framework for asset allocators who are deploying capital into these quantitative models. Let us deliberately walk through the synthesis of our discussion and the practical implications for governing quantitative strategies.
We need a rigorous checklist.
We must apply a rigorous checklist to prevent the silent destruction of alpha we have spent the last hour detailing. First, allocators must demand net alpha reporting from day one.
Looking at gross backtests is negligent. Looking at gross backtests without fully modeled, deeply realistic implementation shortfall is professional negligence. If a manager cannot provide a historically accurate, cost-adjusted net return curve that realistically models bid-ask spread, market impact, and latency, the conversation must end immediately. A gross return is a fantasy.
Completely agree. And second, allocators should structurally favor low-turnover quantitative strategies over high-turnover glamour models. Low turnover naturally insulates the portfolio from the compounding destruction of the bid-ask spread and latency arbitrage.
Because if you trade less frequently, you are simply taxed less heavily by the market microstructure.
Right. Third, and I know we find deep agreement here, allocators must impose hard capacity limits. A strategy must have a mathematically defined maximum assets under management.
Written explicitly into the mandate.
Explicitly written into the mandate, beyond which the fund will automatically return capital to investors, rather than dilute the returns.
I strongly agree with imposing hard capacity limits. It is the absolute only mechanism that protects the integrity of the signal from the greed of the asset gatherer. If a manager refuses to define their capacity constraint, they are tacitly admitting they prioritize their own management fees over the client's net alpha.
Moving to the practical implications, what's our fourth rule?
The fourth rule is to overweight liquidity-resilient exposures. Allocators should target macroeconomic factors and signals that naturally trade in deep, highly liquid instruments.
Like large-cap equities or sovereign bonds.
Exactly, such as large-cap equities or major sovereign bond futures. In those arenas, the market impact is minimized by the sheer, massive volume of the underlying market.
And fifth, regarding portfolio construction.
Fifth, we suggest allocating a stable 7 to 10% of the overall portfolio to proven low-turnover quantitative managers who have demonstrated strict discipline in their capacity governance over multiple market cycles. You are rewarding discipline, not just back-tested returns.
That makes perfect sense. And the sixth rule?
Sixth, conversely, allocators must actively underweight crowded, high AUM systematic products by at least 10%. When you see a standard multi-factor smart beta product swell to $20 or $30 billion in assets, the physics of decay we discussed guarantee it.
The implementation costs eat whatever is left.
The implementation costs, the market impact of rebalancing, and the crowding effect will absolutely erode whatever theoretical premium remains.
And that brings us to the seventh and arguably the most critical, practical implication. This is the ultimate sell signal. Allocators must use implementation deterioration as a hard, objective trigger to cut allocations.
A hard stop.
If a strategy's net returns fall below 2% annualized for a rolling 2-year period, after accounting for all frictions, execution costs, and management fees, the allocator must liquidate the position.
Regardless of the manager's narrative.
It does not matter what the gross signal indicates. It does not matter what the portfolio manager's brilliant macroeconomic narrative is. A 2% net return over 24 months means the institutional tax has fully consumed the economic moat.
The strategy has failed the test.
The strategy has definitively failed the implementation test, and hope is not an investment strategy.
Synthesizing our entire analysis, the central tension of our debate remains clear. You argue that the execution apparatus and the mitigation of implementation shortfall are the ultimate arbiters of success, the final filter that determines value.
Because without it, the alpha bleeds out.
I maintain that you must first possess the high-quality, deeply predictive signal to make any of this governance and execution infrastructure worthwhile. The machinery, no matter how flawless, cannot optimize a void.
But a perfect supply chain?
A perfect supply chain delivering zero intrinsic value is an exercise in futility.
Yet as we review the empirical evidence, from the catastrophic momentum crash of 2009 where liquidity evaporated, to the tragedy of the 15% gross backtest shrinking to a 6% live reality, we see an undeniable, clear pattern.
The continuous shrinkage of sophisticated machine learning alpha being eaten by latency.
Yes. Gross alpha is an interesting mathematical concept. It is a beautiful hypothesis. It is purely a research statistic. Net alpha, delivered efficiently at a strictly governed capacity, is the actual investment product.
While our perspectives on the primary driver of value differ, our convergence on the solution is absolute. We both agree on the absolute necessity of rigorous capacity limits.
And the reality of the hidden tax.
Right. We both recognize the stark reality that the hidden tax on alpha, the spread, the market impact, and the latency delay, is often the largest single determinant of a strategy's realized value over time.
So it's up to the allocators to decide where to focus.
We leave the ultimate weighting of signal supremacy versus implementation dominance to the judgment of the allocators and practitioners who must navigate this friction daily in the markets.
The evidence requires us to reframe entirely how we evaluate quantitative research. The invisible expense ratio is constantly operating in the background, punishing the naive who believe in frictionless markets and rewarding the disciplined who respect the physical limits of liquidity.
It's a brutal reality check.
To distill everything we have analyzed regarding market impact, theoretical backtests, and the brutal reality of execution into a single unyielding law of systematic finance, if a strategy only works before execution, it does not work.
This is the research desk officially signing off.